Hi everyone, this is Amanda with PropLogix. Today we wanted to talk a little bit about refinances, what they are, how they can be valuable to a homeowner. Today I have with me David Daly, who's our VP of Product here at PropLogix, and he has a very long history in refinances and in real estate. So yeah, welcome. Thank you, Dave.
Thank you, Amanda. I am extremely excited to spend some time with you today and talk about refinance, right, consumers and their options when it comes to dealing with lenders. So thank you so much for having me. I really appreciate it and look forward to spending a few minutes with you talking about this.
So can you tell me what a refinance is? Are there different types of refinances?
Yeah, so there are different types of refinances. So let's take a first mortgage, right? I buy a home, I work with a lender, right? So I have a mortgage payment I'm making every month. At some point during the term of that loan, I decide that I want to replace that loan with a new one. So that's the refinance transaction. So I have a loan and I'm going to get a new loan and that one's going to be satisfied. So that's one type of refinance. Another one would be like a cash out refinance. Take the scenario where I have a loan, let's use a $200,000 property. So I have a $200,000 property and I owe $100,000. So most lenders will do an 80% loan to value or LTV. So in that scenario, let's say I want to refinance my home for $150,000, which satisfies the 80%. So I would have a new mortgage, right? So I refinance my existing one, that $100,000 still on the books with the new loan, but I'm going to take out cash, and with that refinance, I'm going to get $50,000. So that's a cash out refinance, which is very popular for people that are looking to do home renovations, maybe want to put some money back into their property. That's a nice way that people have been utilizing that. I have my first mortgage, right? So now I want to tap into the equity in my home. So on a home equity loan, it would be a one-time lump sum payment. So let's take the same scenario that we talked about. I have a $100,000 note and I want to grab $25,000 out of my property and it's valued at $200,000. So then I would receive a check for $25,000. I would have a home equity loan. So now I have what they call a first and a second. So it's a one-time payment. It would be typically it's a fixed rate, so it's very predictable as to what my payment would be, and it starts immediately. If I wanted to do a HELOC, which is a line of credit, it's comparable to a credit card. I don't have to draw on that immediately, right? I don't have to draw on it at all. So I basically have the funds available to me. So I would have a $50,000 line of credit and I'm collateralizing that with my property. 6 months goes by and I want to take out $20,000. I take out $20,000. Typically the draw period, let's say the typical is 10 years. And then after that 10-year draw period, there's a repayment period. You'll see 15 years, that's a variable. The interesting thing about a HELOC and what you want to know is that it's a variable rate. So if I did the equity loan, I know my rate and what it is. If I do a HELOC, it's going to vary based on the interest rates.
What are some of the reasons why a homeowner would want to consider a refinance versus, an additional home loan, a second mortgage, or whatever?
Yeah. So I would say it's the right tool for the job, right? So we've just seen the Fed cut rates for the first time in a long time, right? So the rates are great. So why would people do a refinance on a first mortgage? Let's say you've been in your home for 10 years, you have a 30-year note, right? So your mortgage is the same. There's a whole nother discussion about amortization tables and how much you pay towards your principal. But why someone would do it is because a couple of reasons. One, they want to lower their payment. So if I want to lower my payment, and let's say I'm in an interest rate of 5.5%, and now today I can get 3.5% or 4% because my credit's better. It's been a while since I took that loan, so I'm going to go back and now I'm going to refinance because I'm going to get a better rate. That's one reason which will lower your payments immediately. I might change the term too, right? Because I had a 30-year mortgage and I'm making payments, and the more payments you make, the more that goes towards your principal and less towards interest. Well, the reality of it is you could go back and refinance with a better rate and do a 15-year loan, 20-year loan, have the same payment, and you'd pay your home down quicker. Now, a lot of that requires you to run the numbers and see what makes the most sense for you as a consumer. But those are some of the things that people do, right? They'll refi to lower their payment, they'll want to change their term, they'll consolidate loans. So let's say I had a first and a second. So now I have a first mortgage and I have a equity that I took out for $20,000. And let's say that rate was at 6%, right? And I took it out 8 years ago. I might want to consolidate my first and my second, so then I'll go in and do a refinance based on that.
Right, okay. So some major things to consider is if your credit has improved, right? That would
Yep.
have a huge impact on the rate
Absolutely.
that you get. And then I know also too, there are closing costs associated with a refinance, correct? Is that
Correct.
something that people should also, consider? Like, how do they decide if it's a good deal for them with the overall, time that they have to pay
Yeah.
back and the money that they have to put up front? How do people make that decision financially?
So, awesome question. And that also comes back to the idea of knowing your numbers, right? Because there are costs, right? You have closing costs. Depending on your lender, you could be paying points, but you'll see the advertisements of no closing costs, right? Well, this just means the lender is going to absorb those closing costs. They still exist. What typically you'll find then is that the rate and what you'll pay on the term of the loan is going to be more than what you would. So there's a lot of reputable lenders and offerings to the consumers where you can take out a loan with no upfront cost, right? And that may be a really good solution for you because for whatever reason, you don't want to go out of pocket at the table when you're closing. Ideally, what you'd want to do is if you're looking at making a decision about should I refinance, one, you need to know all the figures, right? So you'll get a good faith estimate. You'll see those numbers when you apply for your application. The lender's going to give you figures. Your lender should have no problem saying, hey, look, I noticed that you offer no upfront fees and you absorb the closing costs. Can I see with the closing costs and what my rate would be? And may I also look at it what it would look like if I was to have no upfront fees? And then you sit down and you run the numbers. But yeah, for sure, if you're going to be refinancing and you're looking to sell your home in a year or two, most likely you're not going to recoup the cost that it took to re-originate a loan.
Right.
So you would want to hold off on that then in that scenario. I would say this to consumers. I mean, anytime you're dealing with money, refinancing, getting a loan, you want to make sure that you do your homework, deal with somebody reputable. I mean, it's all the basic stuff that you'd want to do with a purchase of any magnitude, right? But this is one of those things where you have options. You really need to figure out what you're trying to accomplish, and you mentioned that earlier. I think that's the key objective, is what am I trying to accomplish financially, and how am I going to leverage my asset, which is the real estate in this scenario.
Thanks to everyone who stayed to the very end of the video. If you enjoyed this video, please be sure to hit the subscribe button so you can keep getting great video content from PropLogix.
It's right over here.